Here's the truth about breaking into private equity in Europe. The calendar on your CV matters far less than the caliber of the deals you can speak about. Everyone obsesses over the so-called 2-year rule, but it's not a rule, it's a pattern. If you can tell a crisp, credible deal story, you can move earlier. If you can't, waiting 3 years won't save you. Today, I'm going to show you exactly how the European PE timeline really works, when to move, and how to make the most of every month you've got. You think you need to wait 2 years to make the move into private equity? I moved after 1 year and you can do too. It's not about the length, it's about what you're doing during your full-time work experience. In today's video, I show you exactly how you can get into private equity and what the right timeline is. So let's get started. Hi, I'm Stefan, founder of Break Into PE. I started my career at Morgan Stanley in London, then transitioned to private equity at HG Capital. Since then, I've coached well over 100 candidates across Europe and helped them land offers at top funds, including KKR, Blackstone, Bain Capital, and others. In today's video, I walk you through the practical timeline for Europe, what early truly looks like, why standard works for most, where late becomes tricky, and how to stack your deal experience so you're competitive the moment the right process opens. Let's set the European backdrop, because it's different from the US. In Europe, recruiting is more fragmented, more country-specific, and more relationship-driven. Language can matter, sector focus is common, and processes are less synchronized. London might run a faster cadence. Paris, Frankfurt, Madrid, Milan, and the Nordics often have their own rhythms and preferences. You might see rolling off-cycle processes, case interviews with a commercial tint, and modeling tests that feel less standardized than the US on-cycle. That fragmentation can be frustrating, but it's also an advantage. If you prepare right, you can step into windows others miss. Now, the headline timeline most people talk about is 2 years in investment banking or strategy consulting before making the move to PE. That's the average. It makes sense because 2 years typically gives you enough reps to have worked on at least a couple meaningful deals, built real judgment, and shown you can operate under pressure. But again, it's not the calendar that gets you the offer. It's the narrative around specific transactions and what you personally did. If you've been somewhere for 2 years and can talk through an acquisition model, the deal thesis, value creation levers, risk, and why the sponsors cared, you'll still be behind someone with 14 months of sharper, deeper exposure. I broke in after about 1 year in investment banking. That was early, and I don't want to pretend it's common. What made it work was focus. I was in a tech team at Morgan Stanley and aimed straight at tech private equity. Because I knew that landscape, who the dominant platforms were, where cloud penetration and pricing power were evolving, how vertical software modes form, my conversations with funds went generic. I wasn't saying, I want to work in PE because I like investing. I was saying, in European vertical SaaS, here's where growth translates into durable margin expansion. Here's the KPI profile that matters. Here's what I'd underwrite and why. That's what early actually looks like. Not a magic CV, but a sharp, sector-specific story grounded in real deals and a clear target list of funds. If you're considering an early move, say after 1 year, maybe even a bit less, be realistic about the competition. You'll be up against candidates with twice your time in the seat, which usually means twice the at-bats. The only way you close that gap is through disciplined preparation and radical focus. Know your sector code. Build a fund list that truly matches your coverage experience. Prepare to talk through your life and close deals with line-by-line clarity. What the sponsor thesis was, why the deal almost died, what diligence turned the tide, how the model captured churn and upsell, and exactly what you did. If you can't tell that story yet, you're not too early. You're just underprepared. The fix isn't more months. The fix is more substance. For most candidates, the standard path, 2 years, is ideal. It's long enough to accumulate a couple of deals and short enough that you still fit cleanly into the junior PE track. If you're on this path, think of the timeline in phases rather than dates. Early in year 1, you absorb market structure, debt packages, modeling under stress, and how to run a work stream. Midway through year one, you start asking for exposure that will yield a cohesive deal narrative. Own a module in the model, lead a diligence thread, sit in key calls. By the back half of year one, you should be compiling a living deal sheet, not just titles and tombstones. What you touched, the KPIs you analyzed, the questions you asked, and the judgment you formed. Enter year two with momentum, not just tenure. When headhunters reach out, or when you reach out, you'll be anchoring the conversation on transactions and insight, not calendar math. So let me give you a client example because it shows the difference between time and substance. One of our clients in Frankfurt came from strategy consulting. She had just under 2 years of experience, and her first instinct was to push the move out because she hadn't closed a massive deal. But she had done 2 commercial diligences on industrial tech targets in the DACH region. She went deep on pricing corridors, customer concentration risk, and a very specific aftermarket revenue stream that looked low churn but was actually fragile. We reframed her experience around that insight. In interviews, she led with a false negative she avoided by structuring cohort analysis differently and how that changed the sponsor's view on sustainable margin. That's not a big tombstone, it's not a closed deal, but it's the exact kind of judgment PE funds buy. She landed a respected mid-market fund that cares about industrials. The difference wasn't time, it was how she told her story. Now what about moving later, say 4 to 5 years in? It's still possible for a junior PE role, and we've seen it happen. There's a practical limit. Around 5 years of full-time work experience, especially if you're staying in banking, you're edging towards senior associate or even principal path on the sell side. Jumping back into a junior seat in PE can start to look mismatched. That doesn't mean you can switch. It means you must be intentional. If you've crossed that 3 to 4 or let's say 4 to 5 year mark, you want to show leadership on deals, not just technical excellence, and be open to slightly different entry points like growth equity, sector specialist platform, smaller fund where your maturity is an asset, or even portfolio value creation roles if that's something you find interesting. So after about 5 years, the door isn't closed, but it's very narrow. So the earlier you plan, the more options you keep. Here's a point people overlook. The effective timeline is really measured in deals, not months. If you've done 2 meaningful transactions where you own the stream of work that mattered, you're competitive. If you've done 0 in 2 years, because of coverage dynamics, market slowdowns, or pure bad luck, you need a plan. You can still win by going deep on one live deal, by doing proactive casework, by building a point of view on a subsector and backing it with data, or by running a self-driven LBO value creation plan on a real European target. And when we work with clients actually in that situation, we build a deal equivalent story that shows judgment and creates interview gravity even without the perfect tombstone. Let's talk month-to-month tactics without turning this into a checklist. If you're early in your role, prioritize reps that turn into stories. Volunteer for the hairy parts of the model, where assumptions actually move valuation. Ask to own a diligence lane, where you'll have to synthesize third-party work into a recommendation. Learn your sector's KPIs the way a buyer does, not just the way a seller decorates a sim. As you approach the window where you want to interview, shift your week so you're doing one of 3 things outside of work hours. Deep technical refreshers tied to your deals, sector thesis building with a simple market map and a few data-driven insights, and targeted outreach to the funds that actually hire people like you. Because Europe is fragmented, timing also varies by country and fund type. Look, pan-European platforms might run a steady cadence of hiring. Country-specific funds may go on and off depending on the market situation. Some teams prioritize language fluency and local market relationships. Others are happy with English only, if your sector experience is a direct hit. That's why your preparation should be more like a sniper than a shotgun. If you work telecom and media in London, great. Identify the European funds, large and mid-market, that have been active in those assets. If you're in Paris with consumer coverage and fluent in French, map the Paris buyout houses and the multi-country funds that staff consumer deals out of Paris. The best timeline is the one that lines up your experience, your language, your geography, and your fund list into one coherent story. So for those targeting an early move, think of a focused 90-day sprint. In the first 30 days, build your sector map and codify your deal stories on paper. In the next 30, pressure test those stories with mock interviews and modeling drills that replicate real European tests, time-boxed LBOs with a brief, not a full case pack, and a discussion that leans on commercial judgment as much as mechanics. In the final 30, start conversations in a tight sequence so your practice compounds and your name is fresh in the market. When you accelerate, you're not rushing. You're condensing the activities most people spread over months into a disciplined block. When you accelerate, you're not rushing. You're condensing the activities most people spread over months into a disciplined block. If you're on the standard 2-year path, don't drift through year 2. This is when you turn experience into signal. Refine your deal sheet after every major milestone. Track questions you couldn't answer in a meeting, then answer them that evening. If you're running a live process, think like a buyer. What would make this a bad investment at any price? Funds in Europe love that kind of rigor, and it shows you protect downside, not just chase upside. As you approach interviews, be explicit about the European angle in your stories, and more important, the country specific. If a deal hinged on regulatory nuance, supply chain complexity across borders, or local competitive dynamics, bring that to the front. It shows you can underwrite in a specific country in Europe. And if you're later in the cycle, close the gap by reframing. You're not the too senior candidate trying to start over. You're the person who's led teams through messy work streams, seen cycles, and can hit the ground running in diligence. Come with 2 crisp leadership moments from live deals. How you handled the block diligence item, how you disagreed with the client tactfully and saved a week of noise, how you navigated a financing wobble. Pair that with 1 or 2 targeted fund conversations where your maturity is a feature, not a bug. You don't need 20 processes. You need one that sees the fit. So before we recap, let me share one more quick story from my own journey, because it illustrates how focus compresses time. When I targeted Tech PE, I didn't try to meet every fund in Europe. I made a narrow list that matched my coverage. I was like, okay, who are the top tech private equity firms that I'm interested in? I identified how each platform created value in software, basically pricing power versus expansion, M&A roll-ups, what's kind of their thesis, and build talking points for each. In interviews, I wasn't telling a generic, I love investing story or it's very interesting. I was saying, here's what I learned about net revenue retention in European vertical SaaS. Here's why gross churn is deceptively low in subscale niches. And here's a roll-up play that I would find interesting. That level of specificity is what opens doors early. It's also what carries you at the standard 2-year mark. The clock helps, but the content wins. So let's wrap with the key takeaways so you can act with clarity. First, the European PE timeline is best measured in deals, not months. 2 years is the average because it often yields substance, but the calendar doesn't win offers. Your deal stories do. Second, early moves are absolutely possible if you're laser focused. A clear sector, a tight fund list, and concrete insights grounded in your actual work. Third, later moves around 4 to 5 years can still work, but you need to show leadership on transactions and may have to target funds and roles where your maturity is valued. Fourth, Europe's fragmentation is your advantage if you prepare with precision. Align language, geography, and sector focus, and time your outreach around real hiring windows rather than waiting for some mythical on-cycle. What makes Europe unique isn't just the languages and geographies, it's the way funds prioritize judgment in messy, localized markets. Use that to stand out. Lead with the nuance you've learned on transactions across borders, the regulatory market quirks you caught early, and the KPIs that actually predict durability in European sectors. If you found this helpful, make sure to like the video, drop a comment with any other topics you'd like to learn about, and subscribe so you don't miss the next deep dive. And if you want a tailored plan for your situation, whether you're considering an early jump in your first year, aiming for the classic 2-year move, or navigating a later transition, head to breakingtope.com. We'll help you create the perfect strategy that's tailored to you so you can land your dream role in private equity. I'll see you in the next video.